Liquidity comes back. These crypto assets are about to skyrocket. So these days, the crypto market feels a bit off, doesn't it? Prices look stuck, altcoins underperform, and even stablecoin supply has slowed down since the summer. And you might think the bull market is over. Or is it? In reality, there is a hidden financial plumbing problem going on behind the scenes. And because of this, the pathways that bring money into crypto are, at least for now, partially blocked. And that's why we are seeing a lot of drama, anxiety, and even fighting in the community. What's interesting though, is that this kind of pause has often showed up right before explosive rallies in the past. The market isn't dead. It's far from it. It's just compressing under the surface. And so, here's the real question. When will the money start flowing again? Because that timing will decide who wins or loses in this cycle. Stick around until the end and I will show you why the market feels frozen right now. The key signals that tell us when liquidity is coming back, and exactly which assets tend to move first and hardest when that shift happens. Oh, and by the way, there's a free chart-based curriculum that summarizes all these timing signals. You will find the link in the pinned comment and description, so check it out if you need it. Alright, ladies and gentlemen, let's get into why liquidity vanished, and more importantly, why it's bound to come back. Many people look at the current market stagnation and say the layer 1 ecosystem is collapsing or DeFi is dead. But the data tells a more nuanced story. On-chain usage remains steady. New protocols and applications keep appearing. And development activity has never been so high. Actually, the real cause of this downward pressure isn't about tech failure. It is about a lack of liquidity. The market wants to move, but simply doesn't have the funds to fuel that energy. In fact, this kind of structural stagnation happens in nearly every bull cycle middle phase. Prices over sideways while fundamentals quietly accumulate. This is exactly the time when patience is critical. All the negativity, boredom, anxiety, and lethargy people feel now, it is not the end of the cycle. It's just what happens in the middle. Historically, after this phase, the market tends to find direction. And the moves that follow often surprises everyone. In short, the market is slow now not because it's dead, but because it's still very much alive and preparing its comeback. Uncertainty remains, funds are being readied, and conditions are primed for change, which makes the market look like it's stuck. So the longer this stage lasts, the stronger the next move will be. Now, let's break down why liquidity has dried up. So the biggest reason the market isn't moving right now isn't price, it's the plumbing. Money flow paths inside the financial system are being squeezed from several angles simultaneously. First, due to the government shutdown, the Treasury General Account, or TGA, has piled up funds, and that money can't flow into the market until the government resumes normal operations. Second is the reverse repo market. Normally, this is where private short-term liquidity sits, but its balance has dried up, leaving almost no cash cushion for short-term use in the financial markets. Third is the Fed's QT, quantitative tightening. When the central bank shrinks its asset holdings, cash leaves the system, putting direct pressure on liquidity. When all these factors overlap, it's like constricting the arteries of the entire market. And the assets most sensitive to volatility, they struggle the most. So the stock market suffers less because passive funds flow in automatically. But crypto feels the full shock because there's no such regular inflow. Many people feel stuck, not because the market is abandoned, but because the money paths are temporarily blocked. However, this plumbing issue is not a structural collapse, but a temporary result of policy conditions. Once the government resumes, the reverse repo balance rebuilds, or the Fed eases QT. The blocked flow will burst back open all at once. But the market is not frozen, but building up pressure. So the key question remains: when, where, and in what order will this money return? Market sentiment often reveals the bottom faster than price data. Right? Social medias on Telegram and X communities look like a battlefield, with people panicking and blaming each other. A classic behavior of a liquidity drought. When the market is truly over, no one talks about it. Interest disappears, volume drops, and investors quietly exit. But what we see now is the opposite. Everyone is hypersensitive and react emotionally to every price move. Prices near the bottom often trigger emotional reactions, especially when volatility is low. Another key factor here, as I mentioned earlier, is impatience. Many believe they need to see success in just a few weeks, but each dip feels like the end of everything. But markets aren't a short-term emotional war. They are a long-term probability game. It sounds less sexy, but this is the truth. Even institutional investors are shifting strategies, moving back from crypto into stocks. This is a classic sign of a late cycle adjustment. Paradoxically, the biggest profits often come from doing nothing. So, what do you do during this lull? Stay patient, control risks, and prepare to act when the moment is right. When the breakout comes, patience isn't just a virtue, it is profit. Many investors believe Bitcoin's cycle revolves solely around the halving. But this time, the real driving force is something much bigger: global liquidity. Across the world, expectations for rate cuts are building, governments are preparing to roll over maturing debt, and even central banks are hinting at expanding their balance sheets. On top of that, the US must refinance around $10 trillion in debt until the end of March 2026. China has already begun expanding its money supply, and discussions around easing the supplementary leverage ratio (SLR) requirements suggest that liquidity is being prepared to flow back into the financial system. All of these forces act as pipelines that channel energy towards risk assets. And historically, whenever liquidity expands, Bitcoin, altcoins, and growth assets have all risen together. That's why the peak of this cycle may not arrive 1 year after the halving, but instead align with the moment global liquidity hits its peak, which is why many experts expect that point to come in 2026. In short, the reason this phase feels slow and uncertain isn't because the halving timing is off. It's because global liquidity, not the halving, is leading the cycle this time. And when that liquidity switch turns back on, the market won't just rise. It will move with the steepness of pressure that's been building for years. Now, only one question remains. In a slowed down market, which asset will react the most? The first catalyst is the end of the government shutdown. Roughly $1 trillion locked in the Treasury General account will start flowing back into the market as soon as the government resumes spending. That money will boost liquidity through banks, markets, and liquidity channels all over the world. The second catalyst is the Federal Reserve's rate cuts. When rates fall, short-term bonds become less attractive, and capital seeking higher returns flows into risk assets. The third is the easing of the SLR regulation. It allows banks to hold more assets, reactivating a high leverage environment across the market. The fourth is the potential re-expansions of central bank balance sheets. This has the same effect as a quantitative easing, naturally pushing risk assets higher under the guise of a crisis response. Lastly, China's expansion of its money supply also contributes to higher global liquidity. When these catalysts move in sequence, the first to react is the volatility index, followed by Bitcoin, and then Ethereum. And finally, large cap altcoins. We have seen this pattern often in market history. Ironically, the reason the market is so quiet right now is because these catalysts haven't started firing it all at once yet. When liquidity returns to the market, the biggest movers aren't the coins that drop the most. They're the sectors that have been held down the longest. A clear example right now is Ethereum and the major layer 1 altcoins. The total 3 chart, which tracks the total market cap of altcoins, excluding Bitcoin and Ethereum, has been moving sideways for almost a year, still unable to break the previous cycle's peak. This kind of long box pattern often appears when upward energy is quietly compressing before a breakout. On top of that, Ethereum's unique burn mechanism and long-term lockup structures through ETFs and DATs are steadily reducing supply. Demand may be taking a break, but supply is quietly tightening. The more this gap builds up, the more sensitively prices react. There's also a pattern that keeps appearing in real market data. When Bitcoin confirms the trend first, Ethereum follows. And finally, the large cap altcoin sector wakes up all at once. Historically, the biggest returns in this phase have always come from the top altcoin sectors. Conversely, those who give up their position during quiet times like this often leave the market right before the most profitable part of the cycle begins. The key point is that these rallies happen much faster than people's emotion can recover. Distrust, indifference, and resignation take time to fade, but price can rebound in just a few days. If you keep switching up your portfolio at every price fluctuation, you end up buying at highs and selling at lows repeatedly. The most efficient strategy in the current market is to avoid making big position changes, not locking in risk, and preparing time-based strategies like call spreads or phased entries when volatility is low. On the other hand, there are 2 things that you must avoid. First, impulsively adjusting your position out of boredom. It's not a good idea. The market is designed to weed out investors when nothing seems to be happening. Second, excessively increasing leverage. Forced liquidation during low liquidity won't give the market a chance to rebound. Historically, the biggest profits have been concentrated among the patient. People get tired when prices move sideways slowly, and those tired ones drop out first, one after another. But the real rally begins after everyone has left. The way to stay in this phase is simple. Control your risk, accumulate slowly, and let time convince the market. It's the strategy that should move, not the price. So the market clearly separates those who are prepared from those who've succumbed to boredom. Your choice is being made right now. Finally, let's wrap up where the current cycle is heading and when the heat will turn back on. The confusion, boredom, and impatience that we see in the market now are not signs of the cycle ending, but symptoms unique to the phase just before a turning point. Liquidity is paused, the pipelines are clogged, and investors, losing direction, blame each other. Yet, all these factors have historically been heralds of the biggest rallies. Once the government shutdown ends, TGA funds are released, the Fed cuts rates, and SLR regulation begin to ease, and liquidity gets injected into the financial system in the designed sequence. Then, volatility spikes first, followed by Bitcoin's reaction, and finally, Ethereum and the altcoin sectors start to ramp up. Sectors that have been compressed longer convert that pressure into steeper rises. So the most important thing now is to endure this boredom. The real game isn't decided now, but after this moment. Most participants drop out during this phase on their own, but while some prepare and wait, the market looks still, but inside, the spring is quietly compressing. Ultimately, those who achieve meaningful results know one thing, that you must watch the flow, not the price, when to buy and sell determines everything. If it's hard to create those criteria yourself, you need a reliable system to reference. That's why there is a site that organizes all of this into a step-by-step chart-based curriculum. The Trading 101 link is pinned in the comment and description. It's free and provides detailed trading criteria and entry-exit scenarios. When the spring uncoils, the window to act is short. Now it's the time to prepare, and next is the time to execute. In the end, the market sides with those who know how to wait. So prepare yourself.